Well, good afternoon, wonderful people. Let me turn these ringers off. I wanted to come to you really quickly. Shatika Hassa, CEO of Hustle Financial Solutions, where we help you retire before you expire. So if that is you, we are the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. I want to get on here today, and I'm not going to be on here very long. Just want to be strong, about 10 minutes maybe. Wanted to really just explain the differences between the term policy, the whole policy, and the IUL. The three popular types of life insurance policies that most people are talking about. And, most people know about term, but I'm going to just really briefly talk about that. So bear with me. So the term policy really is that it's temporary, like we talk about all the time. The temporary policy, meaning that it will expire in 10, 20, 30 years. Now, here's the part that most people don't know. You can actually convert the term into a permanent policy so that you can be able to leverage it, right? So you can actually upgrade it, if you haven't done that already, or if you decide you want to do that. But not all carriers do that. Not all policies are capable of doing that. The other thing is you can get your money back. 100% of your money back, up to 100%, anywhere from 65 to 100% of your money you can actually get back. If you decide you want your funds back for whatever reason, or you don't want to upgrade, that's one of the other options. But you have to be with a carrier that allows you to get your return on premium. That's what it's called, return on premium. So if you want to ask about that. So that's the term policy. So temporary, 10, 20, 30 years is the most. Actually, they are few, just only a few that actually allow you to have your term policy for up to 40 years. Now, if you decide you don't want to go the term route because you don't want something temporary, and the reason why people do term, let me just say this, they want to make sure that they have enough death benefit to be able to cover, right? So let's say your death benefit is $1 million, but you can't afford it with an actual, permanent policy. Permanent policy meaning that you're going to have cash value building up in that policy. If you have a term policy and you decide, well, I know that I need $1 million, but I don't have the capacity, or I should say the bank account, to be able to afford a permanent policy because it's a lot more expensive. For obvious reason, you're building up cash value. They're going to invest your money for you. I should say they're going to allow your money to grow for you. We don't like to say invest with life insurance, but you're going to get a bigger return on premium with an actual permanent policy versus a term policy. Let's just say that. Now, you do have some term policies that are now allowing you to get what's called living benefits. So if you become chronic, critical, or terminally ill, heart attack, cancer, stroke, dementia, Alzheimer's, you need some type of long-term care needs, you can actually have that with a term policy now as well. There's a carrier out there that's actually doing that. So you don't want to discount term all the way, right? So if you need those living benefits, that is with some term policies as well. So I don't want to forget that part. Now, that's the term in a nutshell, but definitely there may be some specific questions that you may have. So with a term policy, you definitely are going to want to be healthy as much as possible, more so than with those permanent policies. They're a little more lenient when it comes to the health, and you actually taking a medical exam. So let's just be clear on that. So let's get into the whole life and the IUL, which is where a lot of people are probably, they want to hear about that part because that's the permanent policy, right? So most people want to have some type of return on their contribution. I'll just say that. And they want to make sure that their money is growing for them. So with a permanent policy, your money can grow for you. And I'll tell you this, depending on what carrier you're with, it can do anywhere from around 2% to 5%, 6% with a whole life policy is what's been historically, the rates. So past results does not equal future results, right? So past results does not equal future results. So we can't always say that it's going to happen, right? And again, everything that I'm telling you today is not financial advice, right? I'm not giving you a consultation. I'm just giving you some facts. Like these are the facts. These are the numbers. This is what it's pretty much been doing. This is what you can expect, right? So with the actual whole life policy, you're going to pay for that your whole life unless you have it structured to do differently. For example, you can do what's called a 7-pay, and it'll pay for 7 years. You'll have to pay for 7 years, and that's it. You're done. Super expensive in comparison to a whole life because you're not paying for it your entire life. You're only paying for it in 7 years, or a 10-pay or 20-pay, 10 years, 20 years. So you don't have to pay your entire life, but it's going to be more expensive the less years you actually pay on a whole life, okay? The thing about a whole life is it's not as flexible as an IUL, right? So your premium is your premium, but you do have a guaranteed death benefit. Now, let's talk a little bit about the death benefit because I didn't talk about it too much. But the death benefit, how you come up with the death benefit is going to be, of course, DIME, DIME. So D meaning how much debt are you in, right? Total debt. Figure it all out, right? Your income. Most spouses want to leave their spouse 10 years of income. 10 years of income or on average, right? You might want to leave 20, you might want to leave 5, but the average person wants to leave their spouse 10 years to let them grieve and be able to, rebound. So that's what's happening with the I, income. The M is going to be the mortgage. How much money do you have left on your home, right? So what's the mortgage? And I know that could possibly be something that you include with the debt, but that's just something oftentimes that's going to be separated, right? So the mortgage. And then, of course, E is going to be education for every child, $25,000 per year per child. So 4 years, so $100,000 for a child on average is what you want to leave for your death benefit, right? And then some people might want to leave more or less. It just depends. But basically, that is what the DIME stands for, and that's how we get your death benefit. Because most people say, well, do I have enough death benefit? Essentially, that's what you have, right? When we start thinking about how much death benefit do you need to have. So for the whole life policy, your DIME might be, say, $800,000. I don't know, right? So the death benefit on your policy would be $800,000 on a whole life, but on an IUL, you may be able to get more for the same premium. So now I'm getting into what's the difference between a whole life and an IUL, because you clearly know that a term policy and a permanent policy means two different things. Term, temporary. Most of them do not have any type of cash value, I should say, or any type of living benefits, and they're going to expire. So why get them? Some people, they want to make sure they don't have a GoFundMe, right? They want to make sure that they're going to have some type of coverage, regardless of whether they're going to have any type of, return on their money or not. They want to make sure that their family is going to be taken care of. So it works for who it works for. But who it doesn't work for, if you need permanent policy, then whole life is one that most people know about because it's been around the longest. It's been around since permanent policies has been around, right? Most people don't understand the IUL though. And so I'm going to give you the difference between the whole life and the IUL. So the whole life, you're going to, like I said, pay for your whole life unless you decide you're going to structure it for a lesser amount of time. And it is going to be a lot more expensive because you're doing that. Now, you're going to get a lot more death benefit in an IUL than you will with a whole life policy for the same premium. Okay. So for $800,000, I'm just putting a number out there. This is not something that I'm using factual, right? Because I don't know your age. I don't know your gender. I don't know your health. I don't know your driving history. I don't know how your weight. Okay. So your build has a lot to do with your insurance. I don't know if you smoke or not. So of course, this is not any type of consultation, right? So $800,000, when you look at that with, say, a whole life versus an IUL for the same amount, depending on who you are, you may end up paying $400, a month or something like that. I don't know. You just put the number out there. $400 a month for $800,000, depending on how young you are, on a whole life. But on an IUL, you may get something more like $850 or $875 for the same 400 because the IUL is going to give you more death benefit than the whole life is going to give you. So let's be clear on that. Okay. Now, what is the difference? So your whole life is anywhere, depending on the carrier you're with, anywhere between 2 and 6% in terms of what they're going to pay you in dividends. Dividends is not guaranteed. They don't have to give you dividends. Dividends is based on how the actual, whole life policy, I should say, the carrier performed. Let me put my fan on. So it depends on how the carrier performed, how the actual, how they perform that year. So if they do well, and let's say they, are able to get you 6% back, that's great. They did great. Now, nothing's guaranteed. Past results does not equal future results. So we don't know that they're going to be able to get you that. So you can't expect them to give you a certain amount of money because they did this in the past, right? Same thing with an IUL. But generally speaking, historically speaking, the average IUL has been doing over 8%. Okay, there's some IULs that's been doing 27%, 28%, 44%, 33%. But past results don't equal future results. So of course, there can be no guarantee. So what people love about the IUL is that it's aggressive in its growth. It's called the cash accumulating cow when it comes to the policies out here in terms of how it generates. Of course, you got the VUL as well, but you can lose as much money as you make inside of the VUL, variable universal life. Okay, so variable universal life versus index universal life. So when you hear somebody say, well, they lost money in their policy, they probably have a variable universal life. Okay, so I never talk about variable universal life. I only talk about IULs because I want to speak about the conservative nature of taking out the risk, especially in the environment that we're in right now. So when you think about an IUL, you can go as, depending on your cap, if you have a cap, up to the cap, right? So whatever that amount is that you've been told when you were sold your policy, this is the amount of, this is what your cap is. You could get up to 8% or up to whatever percent. So just understanding what your cap is, but also understanding what your participation rate. And this is where the juice is that most people do not talk about. And you have to know this because I know that there's carriers out here that's only doing 66% participation rate or some type of participation rate, right? Like really small. Those can fluctuate, but you want to make sure your participation rate is, as high as it can be, right? In terms of when I say participation rate, I am talking about if the market is making 10%. And let me slow down because I get excited. If the market is making 10% and your participation rate is 100%, then you're going to get 10% credited towards your policy if you have the cap. If you have a no cap policy, let's just say that, no cap policy. Okay. That means that whatever the market does, that's what you're going to get, right? Now, if you have a participation rate of 66% and the market did 10%, you're only going to get 6.6%, right? So you want to know, like, what's the participation rate of the carrier that you're working? What's what's been happening with that participation rate? So you'll know how your cash value is going to grow. How is it going to be credited? Right now, all index universal life policies are pretty much going to parallel the performance of the S&P 500. So how the S&P 500 performs is pretty much how your policy is going to perform, right? So that doesn't mean that your money is tied inside of the market. That means that your money is going to be paralleling the performance of how the S&P 500 actually performs. In other words, if the S&P 500 does 27% and you have no cap, then you can get up to 27% credited in your account. Of course, these are things that's done annually. Okay, so we're talking about an annual basis, but understanding uncapped versus cap rates and then participation rates inside of your policy. So I just wanted to get into that really quickly, like getting back to the index universal life versus the whole life. The whole life, again, is your whole life, and the index universal life is not necessarily your whole life, but you can get, let's say you have paid up what's called the maximum amount of premiums that you can pay. In other words, you paid up to the MEC limit every year for the first 5 or 10 years of your policy. Well, you had so much built up cash value, you may not necessarily have to pay on that policy ever again because you have enough cash value, right? It's because you've been dumping all this money into the index universal life policy. All right, so let me say something else that's the difference between the two. You actually have a surrender charge for the first 10 years on average, right? And depending on the carrier, you should have about 10 years of surrender charge on your index universal life policy. In other words, if you take that money out, you are going to be charged something in an index universal life, right? On a whole life, you're not going to have that surrender charge, right? On average, right? So most carriers, you're not going to have that surrender charge, but you are going to, I'll just say you may or may not. This depends on the carrier. Let's just be real clear. Depending on the carrier. So just understand you have a guarantee with that whole life, but if you miss a premium and you don't have enough, you can literally lapse your whole life policy. With an IUL, if you lose your job and you have a furlough, anything happens, as long as you have cash value inside of that IUL, that cash value is going to pay you a premium. So there's a lot more flexibility in an IUL than it is in a whole life. Okay, so lapsing your policy is super important, I'm sure, right? So a whole life, you can lapse quicker when it comes to not being flexible because you don't have the money. So if you know that you may or may not have the money, you got what's called a minimum payment that you can pay for the IUL. And then you have the maximum amount, right? Which is the MEC. And most people don't know what a MEC is. So I'll explain what a MEC is. Basically, the IRS says that you will not treat this like an investment. If you do, we're going to tax you, right? So you cannot go above this amount every year or for the first 7 years or for the entire life of this policy. These are what your limits are. So you don't treat this too much like an investment, although most people do treat it like one, right? Let's just be clear. A life insurance policy is not an investment. Okay, it's a different asset class. But at the end of the day, a lot of people understand that the taxation of it is you're going to grow your money tax free, so they love it for that reason. So if you're looking for a tax-free vehicle to put your money into that's going to grow tax-free and you don't have to pay any capital gains taxes on the growth, then you want to get with something like a permanent policy, right? So an index universal life, whole life, and you can do all of them according to IRS code 7702. You don't have to worry about it as long as you stay within the MEC modified endowment contract limit. And that's what you need to understand when you have your policy. If you have a permanent policy, you need to find out what it is. All right. So that those first 10 years of that index universal life, you might want to pound all this money in there. Well, just understand if you're trying to treat it like a bank, you can, but you're not going to be able to get all of your money out those first 10 years. It's going to be all of your money minus whatever that surrender charge is. So let's just say your surrender charge is $8,000 for the first 2 years, right? But let's just say you put all this money in it, you dumped all this money in your first year. Your second year, you want to take a lot of the money out. You think you're going to get all the money out. You're not. You're going to get all of the money minus whatever your surrender charge is that second year. So just understanding that when it comes to the IUL. And now in the whole life, there is no surrender charge on most companies, right? So there's no surrender charge. So you can take all of the money out, things of that nature. But at the end of the day, you got to make sure you pay your premiums or you could lapse the whole life policy. Now, let's just do another recap and a summary between the whole life and an IUL, because I think we're clear on the term. But if there's any questions, please let me know if there's any questions. I'm looking over here. How you doing, Venetia? Twin. All right. So I got a few different platforms. Just looking to see if there's any questions before I continue. Awesome. Good job for you, underrated one. And you're welcome, Paul. And healthcare biz, Twin. I see a bunch of people on Instagram, different people came and gone. All right. I'm not sure who's still over here. But all right. Thank you. Now, either way, we're going to keep talking about so term is temporary. We understand that you get a lot more death benefit coverage for your money, but it is going to expire. And when it expires, when you how should I say it? When you get back into it again, or how should I say it? The words are coming to me. Either way, when you do it again, you say, I want another term policy. I want another term. Then your actual amount that you are going to have to pay for your premium is actually going to go up. It's going to go up. So you just understand that because everything is based off of your age and your health. That's why we always tell you always want to lock in your insurability is the word at the youngest and most healthiest state that you're at. All right. So that's why, the wealthy, they're already planning for their $1 million baby before they even come. So when the baby comes, 15 days after the baby is born, they slap a policy on them. That's another way that they're able to leverage tax-free growth, right? So that's how they're able to, have their tax-free growth on their child. But at the end of the day, 15 days old, their baby has a policy on them. Ideally, it's going to be like an IUL, something flexible, something that they can put a lot more money into. But again, getting back to the term policy is just temporary. You get a lot more death benefit for your money. You can actually have living benefits, return on premium, and you can upgrade it to a permanent policy depending on what carrier you're with. Not all carriers offer that on a term, okay? Especially if you are with an employer, a W-2 employer, you don't have that. You got a general term. You're not going to have return on premiums on most cases. You're not going to have return on premium. You're not going to have living benefits. You're not going to have a convertible. It's not going to be convertible. I've talked to a few people that they have really good employers where they can actually they have whole life policy. They don't even have term. But 99% of you, if you have life insurance on your job, you actually have a term, what's called a group term policy. So when you leave that employer, you don't get to take that with you. It's rented insurance. Okay. So when you leave, you have no coverage. And that's why most people purchase a permanent policy, because no matter where they go, if they float from employer to employer, they'll always have what they own, which is actually collateral. Let's be clear, because the cash value that you have inside of your permanent policy is collateral that you can use for a lot of different types of business transactions, rather it be real estate. You could actually, any type of loan that you're trying to get, you can use the cash value inside of your permanent policy as collateral for your loan. All right, so super important to understand that too. Now, the wonderful thing about life insurance in general, compared to every other type, is that every other type of asset class, stocks, mutual funds, EFTs, NFT, all these things that you're talking about, we talk about putting our money in trading, all those other things, you're going to pay taxes on those other items, but they also are not protected from lawsuits. So with a life insurance policy, you're protected from lawsuits and market volatility. Double protection, right? So we're taking away risk and we're giving you tax-free growth inside of your policy. That's what you have to understand. All right. So either way, I want to see if there's any questions. I know I unpacked a lot of stuff, a lot of information. Man, it's already almost 21 minutes, and I did not mean to go this long. All right, almost 21 minutes. And so are there any other questions? Now, if you are over on Instagram and you want to see the replay, you have to go to my YouTube or LinkedIn, Hustle Financial Solutions on LinkedIn, or Shatika Hustle Financial Services on Facebook, on the business page, because I don't really I'm never on my personal page. All right, so if there's no questions, I am going to get out of here. I guess I did a great job, as they say. All right, but I want to make sure that I answer any questions that you have. But again, if you have, if you want to get with me, or if you know that I do retirement. So basically, if you need a retirement plan, definitely go, do that consultation. But you don't have to do that. You can actually just download the retirement planning guide. If you just want to get started on something and trying to get an understanding on what actions to take as it relates to your retirement, definitely go to shatika.com. Make sure that you go and download the retirement planning guide so that you can start taking action on your retirement. My slogan, as everybody know, is retire before you expire. And the reason why I say that, most people don't know my story, and I could have brought their obituaries, but I didn't. Either way, I have a couple friends that passed away in 2018 to the flu. Within 4 days, they both passed away. One in South Carolina, one in Georgia. Well, nobody expected that. So what I like to see is for people to, be able to retire before they expire, be able to live their life, be able to do what they need to do while they're living. There's so many dreams in the cemetery. Miles Monroe says, the richest place in the world is in the cemetery, because so many dreams are there, right? Because most people don't get to do what they want to do because they've been working. And I'll just say that the tax code is written for the business owner. It's not written for the W-2 employee. And if somebody would have told me that years ago, I would have made some leaps along and bounds a long time ago. But it's not written for the actual W-2 employee, unfortunately. And so if you're trading time for money and you're trying to retire, it's going to be challenging unless you have a way to compound your money. And so one of the wonderful ways that you can compound your money is in a permanent policy, tax-free and protected from lawsuits, where you also get, if something happens to you, you can access long-term care needs. In other words, heart attack, cancer, stroke, dementia. You can access your death benefit and not have to go bankrupt like 69% of people do, because they just don't have the money for these medical bills, right? So either way, if you have an aging parent, I like to tell people definitely take a look at that. So if you have an aging parent, you don't have to come out your pocket. You can, have a policy on them that's going to be able to, assist them with that type, like a long-term care facility if they need that. All right, so start thinking about those things as well. But you guys are pretty quiet today. I know I'm just coming back, and many of you may or may not know me. But either way, I'm Shatika Hustle, CEO of Hustle Financial Solutions, where we help you retire before you expire. So that's you. We're the ones you hire. Our goal really is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. I am done speaking. I will see you at the top, because you belong there. God bless. Go ahead and like the video, share it. Somebody needs this information. And I'm not sure what is going on. I'm trying to stop this.